Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra. Well, the market fall today has clearly wiped off to over 2.5 lakh crore rupees of investors' wealth. So what is really leading to this sharp correction in the markets? Is there more pain ahead? And what should investors like you and me really do to protect our capital now? To discuss all of this and much, much more, I'm joined by a very special guest on this show. Mr. Hemang Jani joins in. He's the equity strategist at Motilal Oswal Financial Services. Thank you so much, Mr. Jani. Really appreciate you joining in on Business Today TV. First up, I really want to understand from you, what are you really making of this crazy market volatility that we've been constantly witnessing, and why are markets so volatile? It seems like we are not going anywhere, but only bungee jumping in a range.
Yeah, hi Sakshi. Thanks for inviting me. Clearly, what is happening, is driven essentially by the global markets and the increased fears that the inflation could remain at an elevated level, and Fed may have to go for more rate hikes, and that is actually driving the sell-off across the emerging markets. And India also, we are seeing on a daily basis the selling number is anywhere from about 2,500 to almost about 3,500 crore. So that is what is definitely driving this weakness in our market, and we think that at least in the near term, till we see a bit of a sense as to the inflation has peaked out, or there is some positive news on the crude front, this kind of a market scenario may continue.
But how much deeper a correction do you see from here? Is there going to be a big one or just marginal? What do you really anticipate?
So what happens, actually, there are two things. One is that at the index level, there may be another 5-7% kind of a correction depending upon the data points. Secondly, what we see is some sort of a sectoral rotation. So certain sectors come into the limelight, and certain sectors go through a bit of a correction. So we think that metals and some of the commodity-based sectors could come in for some sort of a correction, given the backdrop that we have. There is, IT, banking, auto. These sectors could remain, relatively stable.
Okay, so metals may be in for some correction, but on the other hand, the safer sectors to actually focus on could be IT, banks, and auto at this point in time. We'd also get into some specifics going forward, but on a macro level, I wanted to understand first: are these levels of the markets attractive enough for you? Are you fully invested, or are you waiting for some more lower levels? Like you said, 5 to 7% more correction we can expect. So, are you waiting for that level to then enter?
I think, Sakshi, when you're looking to invest in the market, it would not be a sensible strategy to kind of wait out for a certain level or a certain correction, because markets, as we all know, are far more dynamic. So I would definitely go for some sort of a staggered buying, not aggressive one. But having seen a fair bit of correction in the last 2-3 months, it would definitely make sense to kind of start at some point and keep some buffer, because as things are not looking that great, maybe you may have to carry on with this for maybe a few months.
Okay, understood. Also, sir, wanted to understand, there's been this growing discussion on whether the world is really heading into a recession, the US, European Union. If that were to happen, what could be the impact that India really faces right there, and then therefore the equities?
So clearly, there are lower probabilities of a full-fledged recession. We might have a mild one at best at this point of time. But whatever may be the case, if we have a headline or a realistic scenario that there's a recession in US, clearly it would have an impact on the overall growth in the world economy and the kind of flows that one can really expect in the emerging markets, including India. And large part of our companies are also dependent upon US and other markets in terms of, IT, pharma, textile, and so on and so forth. So that could also, go through a bit of a lull patch. So that means that the markets could remain, little subdued for an extended period of time.
Okay, understood. But what really explains the kind of outflows of FIIs that we've seen so far? About $22 billion or so in the last 5 months of 2022. And what does it signal to the retail investors then, who have been constantly, putting in money and putting in their faith in the equities domestically?
See, predicting the flows is going to be a very difficult task, but what clearly it means is that even before the Fed started increasing the rates, there was a selling that was happening by the FIs. Post that, it has intensified, and maybe for another 2-3 weeks, still the inflation number remains high. This may continue, but from a retail standpoint, what I would want to say is that the markets have really not reacted as much as it used to be maybe 5-10 years back. It has remained relatively stable because of the strong money that is coming in through retail. And we should not base our investment strategy basis FII selling, because there may be a lot of media, headline around that. But what matters is what you want to do with your own money and what sort of investment strategy you want to follow, and you should stick to that.
Right, absolutely. So in terms of strategies, how should one really position their portfolios today in terms of both, say, equity and debt? Is it time to be slightly underweight equities, have a little bit more portion of debt? Like you said, that, we are in an interest rate hike scenario. There will be debt schemes that will perhaps offer you better money than before. So how should one really position their portfolios?
Purely from a tactical point of view, I would be more comfortable having some liquidity on the sideline, so that if at all there's a big cut like what we've seen today, and you may have some bad days in the market where Nifty is down 200-300 points, so you could take advantage of that. And other than that, I don't think you should tinker too much with your overall allocation towards equity, because by nature, equity is a little, volatile, high beta asset class, and it will its own challenges. But we should stick to our broad allocation and investment plan.
Right. So in case somebody had to start making their portfolios today, you did say the three sectors you're more bullish on: IT, banks, auto. So if one were to say create some portfolio of stocks, which stocks would you really advise from these particular stocks?
So from Nifty names, I would be comfortable. Let's say in IT, our preferred picks would be Infosys, TCS, and HCL Tech. We'll stick to large caps. When it comes to banks, we would go with an ICICI Bank and HDFC Bank and State Bank, because banking is a much larger universe. Within auto, we like Maruti, we like Hero Motor, and maybe one auto ancillary company, something like Endurance Technology, something that we like. Other than that, maybe we could look at something like Reliance Industries, which has remained relatively stable, but definitely given the kind of business potential and the triggers that we are looking at for next 1 or 2 years, that would also be one important stock to have in the portfolio. And lastly, Sakshi, I think consumer names we should definitely look at adding. So some of the FMCG companies, maybe Marico or a Dabur, it would be good to have in the portfolio.
Okay, so that could be like a balanced portfolio where you have defensives, you have all these kind of aggressive names as well, and the large caps in your portfolio. But one portion, like crude oil, which you touched upon briefly in your initial answers, we have seen that this is a major concern. Crude oil still remains at $120 a barrel. And for India, of course, we always say that it's going to be a concern. Right now, are you seeing any attractiveness in some of the upstream companies? Could that be looked at from a long-term perspective as well? Because keeping in mind that the crude oil prices may not ease very soon.
So Sakshi, from a purely short-term tactical point of view, ONGC and Oil India, you may see a bit of a buying interest, but purely if you're looking at it from a 2 to 3 year perspective, I would not want to get into pure commodity play, and that to a PSU company, because at best they give you a mediocre return or maybe a dividend yield, but they are not genuinely wealth creation opportunities.
Okay. What are your thoughts on LIC, sir? I wanted to understand, because, today again, we have seen the anchor lock-in ends today. The stock is again at a, record low around 700 or so, 710 or so. Your thoughts here on for the investors who got their allotment, what should they be doing? Who've been patiently waiting so far for some turn right there. And for new investors thinking at a long story in LIC, is there any, investment bet?
So typically when the stock goes below IPO price, it remains there for a while, and it may be the case with LIC. I don't think anchor investment by itself, that lock-in period by itself, is a bit of a hurdle. But I would think that if you look at this current scenario where the inflation is high and the growth is low, insurance as a theme tends to do very well. So within the insurance allocation, LIC could be one component, and you could also have some of the other private sector name, be it SBI Life or HDFC Life, and one general insurance company as a part of the portfolio.
Okay. And one more theme now that, of course, we are off late seeing some cases of COVID rise back again, but we were seeing some of these reopening themes coming back into flavor. Your thoughts here, sir?
I think overall reopen theme continues to get very good traction, and particularly hotel companies we are extremely bullish on, apart from the retail place. So within that, Indian hotels, and for small cap investment bet, one can look at a Lemon Tree Hotel, where we are looking at 100% growth over the next year. And apart from that, recently in a conference, we had the opportunity to interact with VIP Industries, and that company is also sounding quite positive in terms of the growth. So these are some of the names which are part of the reopen theme, and where we are expecting good growth going into the next few quarters.
Okay, understood that. Well, on that note, thank you so much, Mr. Jani, for being with us and speaking to us about a whole host of sectors and stocks that investors can look at to beat the current volatile environment. Thanks a lot for being with us, sir.
Thank you, Sakshi. Always a pleasure.